Did China put the last nail in Under Armour's coffin? What do you think? I want to hear what you think about it. I'm going to tell you what I'm thinking. Welcome to the Valuation Masterclass case study, where you'll learn about interesting stocks and how to value them. What's interesting about Under Armour is that its share price has dropped by 50% over the past 6 months. Is it time to buy now? Or is it time to sell? One lesson I've learned in all these years of investing is don't get shaken out at the bottom. This is Andrew Stotz of the Valuation Masterclass. Let's get started. But before we start, remember, this information is for learning purposes only. It's not investment advice or recommendation. So let's first look at first quarter of 2022. Earnings results were disappointing. Wall Street is fed up with Under Armour, Nike, and Adidas. That's from Nathaniel Mayerson of CNN Business. And here's Reuters. Under Armour shares tank after surprise loss, profit warning. Under Armour, here's coming from investment.com. Under Armour, Adidas reel from China lockdowns. So investors have lowered their profit outlooks and they're punishing the share price. Here you can see that within one day, UA's share price plummeted by 25%. At about $10 right now, it's now 53% below its 12-month high. So what sparked the fall? Well, Under Armour reported an unexpected quarterly loss of $60 million US. You know, Under Armour is pretty popular here in Thailand, and I've always thought it's a pretty impressive brand. But they've had some scandals related to misleading investors back in 2015 and some questions of dubious accounting practices. But also, there was companies' expense of strip club visits of employees, so a little bit of scandal there. And then failed acquisitions led to a waste of money. So I want to welcome everybody who's on the live stream on YouTube, on Facebook, on LinkedIn, and on Twitter. I see Arifur Rahman on LinkedIn. Good to see you. Assalamu alaikum. Good to see you. So strategy shift under new CEO hampered by external shocks. During 2020, the company recorded almost $600 million in loss. Now, in China, the ongoing COVID lockdowns have exposed the vulnerability of UA's supply chains. More than 38% of its raw materials come from China and Taiwan. Around 67% of its production is in Asia and mainly China. There's a long way to go to close the gap to competitors. This is what I found really fascinating about the company. It's got terrible profit margins. Now, if you look at these profit margins, this is a 5-year average of Under Armour, Adidas, and Nike. Under Armour still hasn't gotten its SG&A under control, and it continues to be a drag on operating margin. The key here is gross margin, if you see, is actually strong at 47%, but it's that EBIT margin. And what's the difference between gross margin and EBIT margin? It's SG&A. Expenses related to operations, expenses related to staff, expenses related to marketing, and all that. SG&A has been consistently over 40% of revenue. And UA's restructuring plan has not yet borne fruit. They're in some trouble. Look at the ROIC at the bottom. 13.6% for Under Armour versus 25% for Adidas and 46% at Nike. Mainly that's because Nike's got a huge amount of cash. So how did consensus assess Under Armour's before the earnings result? Well, analysts were equally divided between buy and hold. There were 8 analysts out of all of them that were a strong buy, but generally it was broken down between buy and hold. I want to take a moment and just welcome everybody onto the stream. I know I see some friends there on LinkedIn. Porn Tip, good to see you. And Tibohu, good to see you also. Patricia, Santoso, excellent. And there's Lee, welcome. Great to see you all here, and feel free to ask any questions as I go through this, because I'm going to go into the value model on this company, and we're going to look at it in a little bit more detail. The share price has fallen. To summarize, the share price has fallen 50% in the last year. And the question is, it fell 25% in one day. Is it time to buy, or is it time to sell? Now, further downward adjustments are likely after the latest earnings results. Analysts in the market obviously are downward adjusting the share price. So we can see that the median share price has gone from January 22, it was 28. Now it's down to 19. So it's cut almost in half. Optimism is gone. Now that's oftentimes a time to buy. Now, before we go into my valuation of Under Armour, if you want to learn how to value companies in this manner, check out my 6-week online Valuation Masterclass boot camp. The camp starts on May 23rd. You'll learn practical stock valuation skills. You'll learn tools and tips and tricks. You'll get access to the value model, which I'm going to show you in just a moment. And you'll join a group of inspiring, like-minded financial professionals. And hopefully I can help you get a job through my network of thousands of finance industry leaders. Join for just $797 until May 16th, and then the price goes up. Scan this QR code to learn more, or just go to valuationmasterclass.com/bootcamp. So let's take a look at the model. I'm now going to go into the value model. And let's just look at a few things here. The first line I want to look at is the revenue line. Every forecast starts with revenue. And here's what you can see. It's a little bit hard to figure out where this growth is going to be, but it's never been a high growth company. Before 2020, if I calculate the average revenue growth for the company, it was, let me see my number down there, it was about 3%. That's a disaster. Of course, we had a crash in 2020, and then we had a big rise in 2021. But I would say going with about 4 to 5%. In fact, I'm going to say 4% for the next year and 5% for the next 3 years. Now, if we look at the gross profit margin, I'm going to bring it down a little bit. It was as high as 50%, which is massive. I'm going to bring it down to 49%. That gives me a gross profit margin, or gross profit growth, that's 1 to 5%, depending on the year. But the whole key to this company's success or failure is the SG&A as a percent of sales. So on the right-hand side of this slide, you're going to see that I have a valuation that is, you can see the chart in the upper right-hand corner is the current price, the DDM value. Since it's not paying a dividend, I don't have that in there. And then the free cash flow value and the free cash flow to equity value. The company doesn't have a lot of debt, and therefore free cash flow to the firm and free cash flow to equity are pretty close. Now, what's interesting is that if we look at this company's net profit margin, which I'm going to highlight here, that's on line 209 in my value model, we can see that it's going to go to about 4, 5, and maybe 6. Already, that's a bit optimistic compared to what this company has seen before. Now, what I think is most interesting about the company actually is its EBIT margin. The average EBIT margin of a company in the world is about 10%. Nike's EBIT margin in the most recent year was at 17.5%, almost 18%. And here you have Under Armour at 5%. In fact, this is a little bit like Twitter. Twitter has a very high SG&A expense, meaning staff costs, marketing costs. Last week we talked about Twitter. If let's just imagine that Elon Musk took over the company and started cutting the SG&A as a percent of sales. So I'm going to do that. And while I do that, I want you to look at the right-hand side, the upper right-hand side, and you're going to see that the free cash flow value of the company right now is about $9, which is close to the $10 current price. But now I'm going to cut that SG&A from 44 down to 40 this year. And then I'm going to cut it down to 38. And then I'm going to cut it down to 36. Now that would get the margin, the EBIT margin, up to about 13%. That's still below where Nike is. But let's just do that and say, it's going to be 13% EBIT margin. In other words, someone's going to come in and turn around this business. If that happens, then the share price of this company is, the value of it is at about $13. So if that's the case, what we could see is that the company would be attractive. But we don't have any indication that the company is going to do that. So I'm going to go back and I'm just going to choose a 40% SG&A as a percent of sales for the next 5 years. And that gives me a price of about 10.8. And therefore, I would say that I want to go back to the presentation of what I was looking at the beginning. And basically, what I want to try to do is answer this question. Did China put the nail in Under Armour's coffin? And what I would say in this case, looking at this company, what I would say from looking at it is this: excellent product, excellent company, exposed heavily to China, and they're paying the price for that. So they're taking a hit. They took a hit in their P&L, but they also take a hit in their valuation. But most importantly, this company has never been a very highly profitable company. And as a result, with the value estimate somewhere between $9 and $10, let's say, I would say that it is not an attractive investment at this time. What do you think? The share price is down. It just went down by 25%. Would you buy it now or not? Make sure to leave your questions or your answers to that question or any other comments in the comment section down below this video. And I'd love to hear your opinion, particularly if you've been covering the company. I'd love to hear what you have to say. Have a great day. And remember, come back for more of the Valuation Masterclass case study, where we look at interesting companies and try to value them.